Buying a Ford Ranger is not a tax-deductible expense. Now that we have the tradies' attention, this is a message and lesson for all business owners, and not just those tradies, but we do know that the tradies love to get the old Ford Ranger. But what we often see as we get closer to the end of the year, or more specifically the end of the financial year, is people wanting to go out there and buy a stack of assets because they believe or have been taught or heard from Barry down at the bar that those assets will decrease their tax. Now, for something to decrease our tax, it has to be a claimable tax-deductible expense. That is very different to buying an asset. So an asset is typically over the value of $1,000, and the asset will depreciate. And the depreciation is the tax-deductible expense. So to give you a simple example, if you buy an overpriced Ford Ranger for $100,000, then that's going to depreciate year on year. Now, the IRD are going to let you claim a deduction of that depreciation expense, not the entire $100,000. This is what can trip up a number of people, and even people who will go out and buy smaller assets like tools and equipment that are over the value of $1,000, or maybe a trailer or secondhand goods and things that are actually assets, and they will be of the belief that because it's cost them money and they need it in their business, that it's fully tax deductible. Now, unfortunately, what can often happen for these people is that they end up with a surprise from their accountant that it's not actually tax deductible, and it's just the depreciation component of that asset that creates the tax deductible expense, and therefore they've spent a whole heap of their cash on these assets, but they still have a lot of tax to pay. So that's why it's very important to start with, to just understand that when you buy assets, you're not claiming the full tax deduction of the entire asset. Now, this has become probably even more confusing for people because we've introduced investment boost recently, which we can probably talk about in another lesson, but this speeds up the acceleration of that depreciation claim on 20% of a new asset. So you want to go and learn about that separately, but it doesn't mean that you're going to get that money back or that it's instantly reducing your tax as such by buying the asset. It's just the investment boost component and then the depreciation percentage of the other 80% of the asset, but that's specifically on new assets. Now, the second part to this is that we do have a low value asset threshold in New Zealand, and it's only $1,000. Now, it increased from 500 to 1,000. It was actually at 5,000 during the pandemic at one stage, but you can't get many assets for less than $1,000 these days. But if you can, it might be a phone that's less than $1,000 or a piece of equipment, then there's a chance that you can claim that as an entire tax deduction, and that it will decrease your profit and therefore the tax you have to pay, because it's fully tax deductible and not an asset that will depreciate. So two very different things. But as an example, I've got an iPad sitting in front of me here. This is over $1,000. So as much as it's a tool that I use every day in the business, it's not fully tax deductible. I still have to depreciate it, and it loses value over time. And that's the piece that brings the profit down and therefore the tax to pay. So if you have a pool of money and you go and buy up a whole heap of assets, well then just be warned, if you're not putting your tax aside too, you may get a bit of a fright because you've tied up a lot of your cash and maybe even some of the tax money into buying assets. Now, on that same path of tying up cash, remember too that even if you borrow for the Ford Ranger or the large asset, that you're creating a cash flow event. So if you have the money coming in and then the money going out, so the loan in and then the money out to buy the asset, you think, okay, well, nothing has really changed here. But remember, you've now created a commitment of your future cash flow to repay that loan. So when you're buying any major assets, don't just think about the tax consequences or the tax rules. Think about the cash flow obligations that you're committing yourself into the future as well. That's why it's really important for all of us to have some form of cash flow planning in our business to then model in these decisions that we're making. Specifically when we're buying assets, so that we can see, okay, the lender is saying to you, yeah, we think you can afford to buy this, and they're going to direct debit you every month, but have you actually mapped that into your cash flow? That repayment each month, what's that doing to your overall cash flow? A lot of businesses in New Zealand don't do any form of cash flow planning, and to be fair, that's an area that you want to mop up, and you want to be in that top 5% of businesses that do take that stuff seriously, and you do have a better understanding of it. So hopefully that gives you a bit of an overview of not just blindly thinking that buying assets is going to decrease your tax, but it is very common teaching in New Zealand. And unfortunately, there is more to it than that, and it is worth understanding it so that you don't get caught out by it.